Okay,
Yeah,
thank you. So we're going to be touching up just a little bit on learning objective 3,
you're welcome.
just so you understand what happens to these assets after the company is done using them, right? Because they have a useful life. So what happens to them once the company is done using them? In many instances, there are a few different ways in which happens. They can basically junk it. That's the retirement. It's basically scrapped. And that happens sometimes, but not all the time. Another thing that can happen at the end of its useful life, when the party is done with it, they could sell it to another party. That does happen. Um, and then, of course, another thing they can do at any point in time is just like you might exchange your car for a new car, they do the same thing. They might exchange their equipment or vehicle for a new vehicle and thus have an exchange. So, a couple of things that we have to do to understand what we call a disposal of a plant asset is that sometimes a disposal of a plant asset leads to a company having to recognize a gain or a loss on the sale of that asset. Okay, so we're going to just look at all of that. We have to continue to record depreciation up into the day we sell it or retire it, you know. And then we need to, once we do no longer own it, we eliminate that asset by basically zeroing out its accumulated depreciation account and taking that asset off of our books. Okay. How we actually look at things is where your book value is going to come in handy. So whatever the book value is of the asset at the time, we compare it to what we actually earned from selling it, the proceeds. Okay. Sometimes the proceeds are larger than the book value, in which case we have to recognize a gain. Now, you might go back to chapter 5 to the multi-step income statement, and you remember there's a section, the other section, other revenues or gains, other expenses and losses. That's where this stuff is recorded. Okay, it's recorded on the income statement as either a gain or a loss. It's a gain when the proceeds are bigger than the book value. You have to recognize the gain. If the proceeds are smaller than the book value, then you recognize the loss. And that's basically the most important part you have to understand here for this particular section. Okay. So here's an example where a company, right company, sells off office furniture of 16,000. Okay. Um, I think, I'm not sure this F is supposed to be there. You know, you might have heard that expression. What the F is? Why is this F here? So I think that's not supposed to be there. So they sell the furniture on January the 1st, and it already had accumulated depreciation of 41,000. Actually, they sell it. I'm sorry, they sell it July the 1st. It already had accumulated depreciation of 41,000. Since they sold it on July the 1st, they owned it for 6 months. So they're going to need to add the depreciation of 6 months of that furniture, right, to the account. They've calculated it to be $8,000. Okay, this slide is all full of problems, huh? Okay. So here on July the 1st, the date of sale, they would record the final depreciation expense and accumulated depreciation on that equipment. Okay, and that's because, again, they had it for 6 months of this year. Okay. So that's the first thing they need to do is record the depreciation they already had. The next thing they need to do is figure out whether or not they had a gain or a loss on the sale. So in this case, they received $16,000 worth of cash for the asset. What was the asset's book value? Well, you take the cost of the furniture, which was given to you in that sample, is $60,000. The accumulated depreciation, we had to add another 8,000 to the balance that was already there, which is why we did that journal entry. So we subtract out the $49,000 in accumulated depreciation. So the book value was 11,000. We sold it for 16,000. And so the $5,000 extra has to be reported as a gain on the disposal of these assets. So this is what the company will do on its books. Okay, it'll show that it received $16,000 in cash for the sale of that. Okay, that's the cash. They have to remove the accumulated depreciation. All right. So in order to zero out the accumulated depreciation on this office furniture, that's what the debit to accumulated depreciation does. It zeroes out the accumulated depreciation account for this furniture. We all have to zero the account out because it's sitting in equipment. So we no longer have that equipment because we sold it. So that's why we have a credit of 60,000 to equipment to take it off of the books. So to take it off the books, again, we have to take out the equipment and its accumulated depreciation. Totally has to be removed. As you see, the difference is going to be the $5,000 gain. And that's going to be recorded here as a credit because it's going to look like additional revenue for the year. Okay. It's going to be on the income statement. It's going to be a positive impact on the income statement. So it's going to look like a revenue account in that regard. Okay. So that's how it's going to look. What if they sold it for only 9,000 instead of 16,000? Well, basically, you still have a book value of 11,000 here, but now you only have 9,000 of proceeds. The difference is $2,000, and that's $2,000 short, so it's going to be a loss on the disposal of the asset. In which case, the loss should be on this side, should be the typical. Boy, these slides are really. I don't know who did quality control in this chapter, but so the loss is going to be recorded on the debit side of the account here. We're still going to recognize the cash that we earned. We're still going to zero out our accumulated depreciation. But again, we also are going to move this over. The loss is going to be on the debit side here. And we're going to take away the entire equipment for 60 grand here. So boy, this slide really sucks. I hope your book is better. In the case that we actually retire it, we just simply junk it and no cash is received. We simply will take it off the books. Okay, totally. And so basically speaking, this is objective 3 in short. Here we have a company who has an old truck. The old truck had cost them $30,000 and had accumulated depreciation of 16,000. Okay, so that's the situation with the truck. In the first situation, the company sells the truck for $17,000 in cash. Okay, so they want us to do the entry for scenario 1 here. Well, again, they received $17,000 in cash. They have to take away its accumulated depreciation, right? They have to zero out the accumulated depreciation account. They also have to take the equipment off the books. So in order for that to balance, they had a gain of $3,000 on the sale of the equipment because the book value of the equipment would have been 14,000, the difference between these two, and they got 17,000. So that's where the $3,000 came for the gain. In the second scenario, they basically scrapped it. It's worthless, and they simply totally scrap it. In the case of a scrap, there's no cash that's received, right? They simply throw the thing away. Thus, the whole difference, the whole book value, becomes a loss. Okay, and it would show up as a loss. Notice this slide has the loss on the debit column, which is where it was supposed to be on the other slide. Okay. And that is learning objective 3 in a nutshell. Question.